We're going to be looking at examples of audit risk and auditor's response in this video. Just a quick recap. Audit risk is the risk that the auditor might end up giving the wrong opinion when financial statements are materially misstated. This simply means there were material problems in the financial statements, but the auditor ended up giving an opinion to say there were none. This incorrect opinion could be because of two reasons. We could have risks of material misstatement in the financial statements, or it could be because the auditors were not able to detect those problems. If you remember, ROM, as we normally call it, has two elements. We have inherent risk and we have control risk. Inherent risk simply means there are areas in the financial statements which are problematic or risky by nature because they are complex, they require judgment, or they have uncertainty, etc. Control risk is the risk that the client's systems of internal control might not be able to prevent or detect financial statement problems or errors. Detection risk is the risk that the auditor might not be able to identify errors in the financial statements. So think of it like this. ROM is pretty much on the client and their financial statements, and detection risk is related to my work. So if I do not pick up the sample properly, if I do not apply proper procedures, etc., all of those examples come under detection risk. Now, at the planning stage, we have to assess or evaluate audit risk, which means we have to decide whether the ROM and DIA are high or low, and we have to, of course, tweak them accordingly. Because if you remember, if the risk of material misstatement is high, we will need to reduce detection risk so that audit risk can be reduced. Then at the planning stage, we also need to decide what needs to be done about those risky areas. So if property, plant, or equipment are at a risk of overstatement, what's the plan? If you think amounts have been incorrectly capitalized, in auditor's response, you have to outline your approach. So you don't have to give me detailed substantive procedures, or you don't have to tell me exactly how systems are going to be tested. You have to tell me what your plan regarding that risky area is. At the planning stage, it's still like a maybe. The risk is maybe this has happened. Auditor's response will cover what your plan regarding that particular area is. So for your concerns regarding expenses being incorrectly capitalized, your plan could be, I'm going to get the breakdown. I'm going to look at the invoices and confirm whether they have been correctly capitalized. We are going to be looking at different examples so that you can understand how risk can be identified and responses can be drafted. So these are the categories we're going to be looking at. Again, these are examples from the past exams. The idea is to start to get you to think in that direction. This is by no means an exhaustive list. We're just looking at various examples that can help you identify how risks can be picked up, explained, and a response planned. Starting off with the first category, this is your detection risk. Remember, this is purely from the auditor's perspective. So risk that the auditor might not be able to detect material fraud or error in the. If we start looking at examples of audit risk, again, not an exhaustive list, just some examples. Starting off with the first one, if this is the first time your firm is auditing the client, there is going to be a lack of detailed understanding of the business and its environment. And because of that, we might not be able to detect material problems in the financial statements. Additionally, because we didn't audit last year's financial statements, the current year's opening balances could be misstated. My plan is I'm going to allocate additional time in my audit plan so I can gather detailed understanding of the client. I'm going to assign experienced team members, and I'm going to increase my testing on opening balances. You do not have to write all of these responses. You could just write one as long as it's properly explained. Another example, again, leading to detection risk is time pressure. So the client wants the audit to be completed 1 month after the year end. This basically increases detection risk because we might be rushing through our work. So this leads to a higher chance that we as auditors might not be able to detect material fraud or error. And my plan is quite similar. I am going to allocate more staff to the audit so that I can make sure that I do not rush through anything. I should try and make sure that more experienced people are a part of the team. So if you look at the concept, the way to manage detection risk is purely how the auditor can fix their team in terms of experience, etc., etc. Moving on from detection risk, now we're looking at revenue, which is a class of transaction. So we're looking at revenue for the year. Now, there are different ways this can be tested, but something that you need to keep in mind is revenue is normally going to be at a risk of overstatement. So client would normally want to recognize revenue early, leading to a higher revenue for the year. Now, let's look at a few examples, starting with the first one. Customers who wish to purchase a property are required to place an order and a 5% non-refundable deposit before the completion of the building needs to be given. Now, if the performance obligation has not been fulfilled, you cannot recognize revenue. That's the basic concept you have to keep in mind. And that's exactly what we're going to write over here. The risk is that this deposit might be recognized as revenue before the performance obligation has been fulfilled. And because of that, your revenue could be overstated and your liabilities could be understated. So remember, when the deposit is received, because I haven't done my work yet, you could debit cash or bank because the money has come in, but you cannot recognize it as revenue until the performance obligation has been completed, right? So we are going to record this as a liability. Instead of income, this is going to be a liability. My plan is I am going to discuss with the management the treatment of the deposits that are received in advance to make sure they are booked as a liability. And I am going to increase testing over the cutoff of revenue and completeness of deferred income. Now, cutoff means revenue should be recorded in the correct accounting period. So I should not be recognizing revenue too early. So increasing my testing of procedures just to make sure they haven't booked revenue early. In another example, similar concept. Now, customers pay for 10 music lessons in advance. The risk is they might recognize the full revenue as as revenue instead of treating it as deferred income, and exactly the same financial statement impact. Revenue could be overstated and liabilities could be understated. My plan is quite similar. If you look at the auditor's response, we're going to discuss this with the finance director to see how it is recognized. And for a sample of bookings that have been done closer to the year end, we are going to check they've been recorded correctly. So again, my biggest concern is closer to the year end because I want to make sure they have not booked this as advance as revenue already. Another example, and we're continuing with revenue. Now, this time around, they offer a 3-year servicing agreement, which is paid at the start of the agreement. And because this is for 3 years, I cannot recognize all of this in the current accounting period. The risk is they might have recognized this all in advance. Exactly the same financial statement impact. Revenue could be overstated, liabilities could be understated. Very similar response. I'm going to discuss this with the finance director to find out how the revenue is allocated. It was obviously a different type of contract in the previous example. Over here, I'm going to take a sample of the service contract sales transactions, and I am going to make sure they've been recorded in the correct accounting period. So debit, bank or cash because money has come in. But for the 3-year servicing agreement, I can only recognize this year's income. The remaining 2 years' income is money received in advance. It needs to be deferred as a liability. So if you look at the trend, it's quite similar. We have the next one then. The company has a returns policy which allows the customer to send the goods back within 28 days of purchase if they're not happy with the product. Exactly the same concept. Again, if you remember, IFRS 15 says that revenue can only be recognized to the extent that the goods will not be returned. So they need to estimate and book a refund liability for goods which are expected to be returned. This is an estimation. There is a higher chance of manipulation or bias over here, and the risk exactly is the same, that they might book this as a revenue and your liabilities could be understated. Exactly the same response. Starting off, remember the response means my plan. So starting off with a discussion with the finance director regarding the returns policy and how it has been applied. I am going to, because it's an accounting estimate, I'm going to review the assumptions which underpin the liability for reasonableness, and I'm pretty much okay with the responses regarding this. In another example, quite similar, customers purchase goods on a sale or return basis, and under the terms of the agreement, customers have 60 days during which any returns can be made. The director has historically assumed a rate of return of 10%. However, they now feel that this is quite a bit and they've reduced it to 5%. Again, an element of manipulation is there. My concern is that they might have intentionally reduced the refund liability. Because of that, revenue could be overstated and liabilities understated. So this is my identification and this is my financial statement impact. Again, same concept, same trend. We are going to discuss the basis of the revised assumption with the director to see if it is reasonable, because I need to see whether there are genuine reasons for reducing this. Slightly different, a customer has sent 120,000 worth of faulty goods back to the company just before the year end, but a credit note has not yet been issued. Now remember, a credit note is for sales returns. You normally debit your receivables when you sell the goods. When they've come back, you're going to raise a credit note to tell yourself that the goods have been returned. So think of it like that. The risk is because the return did happen before the year end. This needs to be booked as a sales return. The risk is they might not have done that to show extra revenue. And because of that, your revenue and receivables could be overstated. My plan is I am going to look at that credit note and confirm that the sales return has been booked. So the idea is very specific plan for this risk because we are talking about a particular order that has been sent back. In other examples, similar concept. This year, the company made a price promise to match the price of its competitors for similar products. Customers are able to claim the difference from the company for 1 month after the date of the purchase of goods. Again, an estimation is needed. This is quite subjective. It requires a lot of judgment. We need to estimate or anticipate the refund amount and book a liability to that extent instead of booking it as revenue. The risk is this might not be done correctly, and because of that, your liability could be understated and revenue overstated. My response is quite similar. I'm going to discuss this with the management. The basis of the refund liability need to be discussed so that we can evaluate that basis for reasonableness. So if you look at all these 7 examples, my risk primarily was the concern that revenue might have been recognized early, and my plan always started off by discussing the assumptions or the basis with the management and then going on to the next step. I would not recommend writing a discussion with management as a response for every risk. Over here, this is a good response or plan, as we call it, for areas which require estimation, but you should try and look for better quality responses in other examples. Moving on to trade receivables. So revenue, remember, is a class of transaction. It's for the year. Trade receivable is an account balance. it is also at a risk of overstatement, mainly because there could be debts or receivables which are not recoverable, but the management is not writing them off as bad debts. Looking at the first example, the credit controller has been on a sick leave and the collection period from receivables has gone up from 40 to 67 days. So it's taking the receivables longer to give us the money, and the credit controller is meant to be chasing the receivables, right? So the risk is that some of these debts might not be recoverable. And if they've not been written off, your assets or trade receivables could be overstated and allowance for receivables could be understated. You could also write that bad debt or irrecoverable expense could be understated. Now, my plan could have a number of options. We are going to look at, or we could take a sample of old receivables, so maybe more than, a certain number of days old, and discuss them with the management to see whether an allowance is required. We could be looking at communication between the customers and the client to see if there's any indication that this is a disputed amount and will not be paid. We could also see if any money has been received from the receivables after the year end. So if we have a receivable recorded at, say, 120,000 as at the year end, and they've sent the money after the year end, it was obviously a recoverable amount. So post year-end receipts would give you a clear indication that this is a recoverable receivable. That rhymes. Anyway, in another example, a significant customer has informed the client that it is experiencing financial difficulties. The director does not think an allowance is needed, and they haven't really done anything. Very similar to what we've just discussed, the concern is that this might not be recoverable, and if you do not recognize this as an allowance or a provision, your receivables could be overstated and allowances or liabilities could be understated. If you look at the responses, they're exactly the same. Correspondence means communication. Any indication regarding recoverability could be picked up from there. I could be looking at post year-end receipts from that receivable. So pretty much the same responses. Moving on to the next category, which is again an asset, other current assets and receivables. So we covered the double entry, which was for credit sales, debit receivables, and credit revenue. We're looking at other categories. So not trade receivables, could be contingent assets, etc. Remember, they would normally be at a risk of overstatement. A trade discount receivable is expected to be recognized at the year end. Now, the receivable is going to be based on their assessment of annual purchases from the supplier, which could differ from the supplier's calculation. Now, this obviously the background isn't given, but the scenario was that they were meant to be getting a discount if they buy a certain number or certain quantity from the supplier, and they had predicted that they would be buying that quantity and booked a receivable automatically. So my concern is that maybe their estimation could be incorrect and maybe this receivable should not have been booked. So concern regarding whether this is actually a receivable that can be booked. And in terms of my responses, again, this is an estimation to a certain extent. I could be comparing the calculation to supporting documentation, which includes the supply contract, which includes the volume or quantity ordered in the past, etc. I could be looking at after the year-end correspondence with the supplier for any evidence that they are going to be getting the discount. Remember, if the discount is virtually certain, they could be booking it as a receivable. In another example, Apple is planning to include a current asset of 0.8 million, which relates to advertising costs incurred and adverts aired before the year end. So they had paid for their advertising and all the ads were actually sort of shown before the year end, but they had booked part of this as a receivable because they were saying that, oh, we're going to benefit from this in the future years. Remember, if the expense has already been incurred and the ads have already been shown, all of this belongs to this year. So you can't really, instead of debiting the expense, you can't really show it as a receivable. So the risk is that this needs to be recognized as an operating expense. You cannot book it as a receivable. And if you've done that, your current assets and other income is going to be overstated and expenses understated. My plan is to confirm that all the expense does belong to this year end. So I'm going to look at supporting documentation to see the ads were aired before the year end. And I'm going to ask the management to remove that current asset and book it as an expense. Because this is an identified error, my response can't be, I'm going to ask the management why they've done it. It doesn't matter what their reasoning is. I need to get them to correct it. In another example, they've included a receivable. Again, this is similar to the first one, relating to a supplier rebate based on purchases for the year. Exactly the same situation. They've just worded it in a different manner. They've booked this as a receivable, which can't be done unless it is virtually certain. My concern is that they might not actually be buying the volumes that need to be bought to get that rebate. And because of that, your receivables could be overstated. My plan is I'm going to ask the management the basis of the rebate calculation and agree them back to the contract with the supplier. And I could be looking at post-year-end communication with the supplier. So 1 and 3 are exactly the same. They've just been worded in a different manner. In another one, quite similar, they have included a current asset in respect of an insurance claim relating to the fire. Unless it is virtually certain, you cannot book that as other income and a receivable. The risk is that they have booked it too early. Because of that, your assets and profit are overstated. So they must have had some, fire, for example, and although the insurance company hasn't confirmed they're going to be giving the money, they've booked a receivable. So they've debited the asset and they've credited other income. And IS 37 says, unless it is virtually certain, this cannot be done. I'm going to ask the management why they feel it is virtually certain, because if they've had some communication, which is pretty much a confirmation from the insurance company that they are giving the money, then I don't mind the receivable. However, if there's been no confirmation, I am going to ask them to reverse this. So if the receipt is not virtually certain, I am going to ask them to remove it from the receivables and other income. Quite similar, a current asset has been included within the P&L. This is an anticipated payout from liquidators who are handling the bankruptcy of a customer who owed the client 0.9 million. The sum of 0.9 million was written off in the prior accounts. So they had a bad debt, they wrote it off, and there'd been some public announcement to say some of the money might be recovered. Now that public announcement does not count as the inflow being virtually certain, because they've not had any formal communication or notification from the liquidators. This is not virtually certain and you cannot book this as a current asset. If this is not reversed, you are going to be overstating your profit and assets. My plan or my response is I'm going to discuss this with the management to see if they have received any notification because of which they're virtually certain. Because if it isn't, I'm not going to let you book that asset and other income. So if you look at the trend, it's quite similar. And if you understand the first two examples, you automatically start getting the hang of the rest of them. So for the next one, similar to what we just did, they are including a current asset of 0.7 million relating to advertising costs, which were incurred and ads were shown before the year end. There's nothing new. The risk is instead of an asset, this should be an expense. And if you don't book this as an expense, your assets and profit are going to be overstated. Exactly the same response. My plan is to confirm the ads were shown before the year end, and I'm going to ask the management to reverse the asset and other income. If you understand the basic idea that the client would want to overstate their assets, and my plan is to A, of course, get confirmation it is overstated through documentation discussion, and then B, get them to reverse it. It's pretty much the entire receivables portion covered or understood. In another example, very similar, but this is a slightly different terminology. The client has stopped further sales of one of its paint products, and they've done a product recall for any goods that have been sold. Now, if customers have already paid the money, that needs to be given back. So we're talking about a refund liability. But for any for any customers who haven't paid us yet, the receivable will need to be written off. So the idea is it's a combination of different elements. When the products are being recalled, this would have a number of impacts that can be discussed. You could be talking about booking a refund liability for customers who've already paid. We will need to put the inventory back in, and potentially, because it's faulty inventory, at maybe scrap value. And if we do not book this product recall, you could have overstated revenue, you could have understated liabilities and misstated inventory. This is not really other receivables. It just had elements of different elements. So I've put this as an example towards the end. So different elements that you could be looking at. The response on my plan is I am going to get a list of the sales of the paint product which were made until the date of the recall, and I am going to make sure they have been removed from revenue and the inventory has been recorded back. So we are going to make sure that all the adjustments have been made in the financial statements. Moving on to our next category, which is also an account balance, property, plant and equipment. Again, they will be at a risk of overstatement because the client might want to show higher assets. The company purchased and installed a new manufacturing line. The cost includes the purchase price, installation cost, and a 5-year servicing and maintenance plan that they have also capitalized. So they've actually added this 0.5 million to property, plant, and equipment. Now, the servicing costs relate to a 5-year period and need to be charged to P&L over this time. They cannot be recorded as a part of property, plant, and equipment. The upfront payment that you've already done, so the advance payment is actually a prepayment that you need to book separately. And if you don't do these as two separate entries, your property, plant and equipment and profits could be overstated. So you need to get them. So think of it like an accountant. They need to remove this 0.5 million from property, plant and equipment, credit that and take it out. Then the part of the maintenance plan that relates to this year can be recognized in P&L, but the rest cannot be, because that's like money that you've paid in advance. So you have to think in that direction. I will need to review the purchase documentation of the new manufacturing line to confirm the exact cost of the servicing agreement and that it does relate to a 5-year program. And then I'm going to ask the management to make the necessary adjustments. So that's something you can be writing as a risk response. Surplus fixtures and fittings from the stores were sold during the year and they had a loss on disposal of 450,000. Now, major losses or gains on disposal could indicate that your estimation of useful life was incorrect. So the risk is that the accounting estimate regarding depreciation could be incorrect, because of which expense could be understated and assets overstated. My plan is I could recalculate the loss on disposal and match it to supporting documentation. I should also be assessing or reviewing the reasonableness of the useful life or the estimate to see whether this is appropriate. Now, in another example, during the year, the client has spent 2.4 million on refurbishing its stores, and they've capitalized all of this. The concern is some of this might be revenue expenditure and might need to be expensed off. If that has not been done, your assets are overstated and expenses are understated. The response on my plan is I'm going to get a breakdown. I'm going to match the invoices to confirm whether this amount could be capitalized. So I'm not saying all of 2.4 needs to be expensed off. The idea is I need to evaluate if all of it can be capitalized. In the next example, there's been revaluation from 3.8 to 8.4, and revaluation again requires judgment estimation. My concern is that this might have been inflated intentionally. So the valuation upwards might not be a genuine increase. And because of that, your assets could be overstated. Property, plant, and equipment could be overstated. I need to discuss. So as my plan or my approach, I'm going to discuss with the management or the directors the basis on which the revaluation was done so I can evaluate the assumptions. Moving on to a frequently tested one, the period over which plant and equipment is depreciated is extended from 5 to 8 years. So when you increase the useful life, your expense per year goes down. The risk is that this might have been done intentionally to manipulate the financial statements, and because of that, your expenses could be understated and property, plant, and equipment overstated. The plan is I could discuss with the management the basis of increasing the useful life. I could look at the condition of the assets to see if they are going to be lasting longer. So my plan is more generic, but if once you've covered your substantive procedures, you would be in a better position to think of the next steps that you can carry out to decide how your response could be for this particular risk. So the client has included in wages and salaries costs involved in preparation of the site for the new machinery and in testing the machinery. My risk over here is now quite the opposite. They have incorrectly expensed off amounts that can be capitalized in property, plant, and equipment. Remember, costs that are directly attributable, costs incurred in bringing the asset to the current condition for its intended use need to be capitalized. So over here, the risk is my assets are understated and wage expenses overstated. I need to discuss with the management, tell them what the correct accounting treatment is, and I need to ask them to correct this. Because this is an identified error, my response, my plan is simply getting them to correct this. The company has purchased and installed a new system, and the costs that have been capitalized include staff training costs. We know this cannot be done. This has been incorrectly capitalized. My assets and my profits are overstated. They've not expensed this off, therefore my profit is overstated. Because this is an identified error, the plan or the response is I'm going to discuss the treatment with the finance director and I'm going to ask them to adjust this. This is a very interesting one. The company or the client has placed an order for 2.4 million of machinery. They've paid $1 million in advance. The machinery was due to be received in July, but will now be delivered after the year end. Remember, assets which did not physically exist for the client at the year end cannot be capitalized. So you cannot capitalize the 1 million because as at the year end, we did not have that asset. If they've booked it as property, plant, and equipment, then your non-current assets are going to be overstated. I need to inspect the non-current asset register to make sure that the 1 million advance has not been capitalized. Because if it has, I am going to ask them to remove it. Moving on to my next category of assets, which is intangible assets. Remember, we are looking at the asset category still, so the concern is going to be overstatement. With intangible assets, you should be comfortable with development expenditure and you should be comfortable with acquired patents, licenses, brands, etc. Starting off with the first example, the client intends to capitalize within intangible assets all costs incurred of 16 million in respect of development of a new smart television model. IAS 38, if you remember, says that development expenditure can be capitalized if certain criteria is met. The risk is the criteria might not have been met and that this should be research expense instead. If they've incorrectly capitalized it, your intangible assets are overstated and expenses are understated. Similar to IAS 16, which was property, plant and equipment, I'm going to get a breakdown of the expenditure and match it to the supporting documentation to see if they meet the criteria of development cost. In another example, they purchased a patent for 2.6 million, and this gives them the exclusive right to manufacture something for 4 years. They have capitalized, the capitalized cost comprises the cost of patent and other costs such as legal fee and administrative costs incurred in negotiating the contract. Very similar, my concern is that all of these costs should not have been capitalized, particularly the administrative cost in negotiating the contract. And if they've done it, this means your intangible assets and profit could be overstated. A separate risk could be because it's for 4 years, they might not have amortized this over the useful life. I'm going to get a breakdown of the total amount. I'm going to review the costs, match it to the supporting documentation. I need to make sure that only those costs have been put in the SOFP that are allowed to be capitalized. In another example, they purchased a patent at the end of the last year, which had a useful life of 4 years. But even in the current year's financial statement, the carrying value is still the same. My concern is regarding amortization. Because it had a useful life, the risk is that they have not amortized this because you can see they haven't done it. And because of that, your assets and profit are overstated. So intangible assets are overstated and amortization expense is understated, which overstates your profit. I'm going to make sure the useful life is 4 years by matching it to the supporting documentation. I am going to ask the management to record the amortization expense. So again, identified error that needs to be corrected. Similar to what we've just done, they purchased a patent for 1.1 million and this can be used for 3 years and they have expensed this to the P&L. So actually not similar, quite the opposite. This time around, they do not know IAS 38 and they did not realize that this can be capitalized. And because they've incorrectly expensed this off, the risk is your expenses are overstated and intangible assets are understated. So if you look over here, your intangible assets are understated. So you need to reverse the expense, capitalize this, and then amortize this over 3 years. I need to make sure the purchase price is 1.1 million and the useful life is 3 years. And I'm going to ask the management to carry out the adjustment. This client spent 400,000 on advertising and they've capitalized this as an intangible asset and they're amortizing this over 2 years. We know advertising expense cannot be capitalized and because they've added this in their SOFP, your assets are overstated and profit is also overstated. We are going to ask the management to adjust this and record this as cost for the year. So if you start picking up the trend, your responses become quite easy. And I think this is my last category of assets, which is your current assets or your inventory. Remember, when you talk about inventory valuation, we need to be looking at cost. We need to be looking at the net realizable value. And the net realizable value is the estimated selling price less estimated costs. So if the client wants to manipulate the financial statements through manipulating the inventory, they could be overstating cost or they could be, of course, not recording this at the lower of cost and net realizable value. Starting off with the first one, the company is planning to undertake the full year inventory count after the year end and then adjust for the movements. Now, very quickly, an inventory count is a part of the client system. Ideally, at the year end, they go in. So the client or the management goes in, they confirm the quantity, and later on, they work on the valuation. As auditors, we don't carry out the inventory count, we only observe it. Because it's not being done at the year end, they're going to be doing it later and adjusting for differences. My concern is errors. In that reconciliation or adjustment, your inventory could be under or overstated. My plan is I'm going to attend the count held after the year end. I'm going to note details of any goods received or dispatched after the year end, and I am going to make sure that's all there in the reconciliation. Remember, your statement of financial position is as at, so I need the balance as at the year end. Quite similar, the year end is 31st of August, but the count is going to spread over 3 days and adjustments are going to be made. Exactly the same concern, exactly the same response. My concern is in carrying out those adjustments, there could be errors and therefore my inventory could be misstated. I'm going to attend the count as a plan, observe procedures to make sure the goods that were received or dispatched during that count are properly recorded. Because in that reconciliation process, I need to make sure the year-end inventory balance is arrived at properly. This is slightly different. So the client has a central warehouse and all of the 20 branches will be carrying out the count as at the year end. However, the auditor is not going to be able to observe all the branches. So the risk is slightly different. My detection risk goes up. If I'm not there to observe the count, my concern is I might not be able to detect material fraud or error in the inventory balance. My plan is I should assess which of the counts to attend. I should try and make sure that I attend the counts at the warehouses which have the largest amount of inventory or which had problems in the prior years. So definitely the central warehouse and then a sample of branches which has the most material balances. So again, it's a practical issue, but I could try and manage it to reduce my detection risk. I should try and attend all the problematic warehouses. So the team, again, this is similar. We'll only attend the work in progress counts at 5 of the 16 sites, exactly the same. The concern is detection risk could be higher. The plan is I'm going to try and attend the counts or the warehouses which has material work in progress. Now moving on to a slightly different version. So up till here, the focus was on the quantity. So we were looking at inventory count. We're now moving on to valuation. There was a flood which damaged the inventory and the selling price may need to be reduced. There's a risk that NRV is now lower than cost. And if inventory is not written down, it could be overstated. I need to work on the estimation of the net realizable value. So after the year end, how much was that damaged inventory sold for? I'm going to compare it to cost and make sure it's been recorded at the lower of the two. So the idea is if a unit cost a 10, but because of the damage, it can only be sold for $3, I need to write it down by $7 and record it at 3. The client would not want to do that because they would want to overstate their inventory and profit. In another example, the prices of components have increased steadily, leading to a reduction in gross profit margin, but inventory is still valued at cost. A different way of saying exactly the same thing. Your margins are going down because your products are, becoming more expensive. So it's still at cost. You might not be able to sell it for that much. And because of that, your inventory could be overstated. I need to ask the management if they're aware of this issue. And for a sample of goods, I need to compare the cost to the estimated selling price. In another example, your inventory this is again damaged inventory, and the holding period has gone up. So remember, with normal inventory, if you're keeping it for longer, there is a risk that your NRV might have gone down. If the client has not recorded this at the lower of cost and net realizable value, your inventory could be overstated. This is also sort of supported by the fact that the holding period has gone up, which means that this might need to be written down. I'm going to ask the management whether it is going to be written down. I'm going to ask them why the holding period has gone up and whether they have recorded the impact on the estimated selling price. So that's my plan. Again, similar to what we've done, I think pretty much repeating the same concept. This was damaged as a result of the fire. The balance has increased by 1.9 million and the days have gone up from 117 to 135. I am now concerned about a number of things. Now, if your balance was, if your inventory was damaged as a result of the fire, how come your inventory balance has increased? If it's damaged, you write it off, right? You either scrap it or maybe the NRV is now 0 or at least write it down. So why is your balance going up when in reality your inventory was significantly damaged? The risk is they've not written down the inventory. Because of that, assets could be overstated. My plan is to discuss this with the management, how they've identified the damaged inventory, and then of course, compare the cost to the net realizable value. Now, this was slightly different. I liked this one because it was slightly, problematic. Now, they do value their cost at the lower of cost and net realizable value. So that's not the problem. It's the comparison is not the problem. It's the cost. So, when I say the cost is 10 and the NRV is XYZ, this risk relates to the cost. The cost includes general overheads, which is not allowed. So they cannot be added. It's only the production overheads that can be added. And because of that, your cost is overstated. I'm going to discuss this with the management, the nature of the overheads that have been included. And if they are general overheads, I am going to ask them to remove that. So it wasn't about the comparison this time around. It was about how the cost has been determined. In the next example, so they have a material level of work in progress at the year end because they have annual contracts for many of the buildings that they're constructing. Now, if you remember, we have 3 types of inventory: raw material, work in progress, and finished goods. This is particularly problematic because we have concerns regarding the percentage completion. So there's a bit of judgment involved in percentage completion. My risk over here is regarding errors or misstatement. Because this requires judgment, it is complex, and my concern is they might not be estimating the percentage completion properly, which could affect the work in progress balance at the year end. Because it's an estimate, a good response or plan could be, I'm going to discuss this with the management, the process that they undertake to assess the percentage completion. And I am going to review this at the year end. I am evaluating whether that process seems reasonable. We could be considering an independent expert because we might not have the expertise for this. So that's my plan. I could either evaluate the appropriateness of percentage completion process myself, or I could get the help of an expert.